Good morning, everyone, and welcome to our first private equity webinar. It's called Knowing Your Next Move and Demystifying and Navigating the PE Journey. It's a bit of a mouthful, so apologies for that. For those who don't know me, I'm Sebastian Stevens. I lead our private equity offering here at BDO in Australia. Today, I'm joined by Mark Ambrosis, and Mark's the Managing Director and co-founder of Armitage Associates. Armitage is a growth equity firm founded in 2016 in partnership with the Schwartz family. And they provide capital and management support to small, medium-sized businesses in Australia and New Zealand. So welcome, Mark.
Thanks, Seb. Great to be here.
Now, before I kick things off, we've got to tell you a little bit of housekeeping. So the first thing is, to start, you'll all be automatically muted, just to stop background noise, etc. But we will be accepting questions throughout the session, and you could submit those through the question tab that should be on the screen. And we'll try and get to as many questions as possible, depending on time. However, if we don't get back to you, we'll follow you up on after the session finishes. And if you are experiencing any technical difficulties, there is a support button which is on the bottom of the screen, I understand. So please click that and somebody will give you a hand. And then finally, we are recording this session and everyone will get a follow-up email containing the slides, which they're pretty minimal in this situation. It's going to be mostly Mark and I chatting. A link to the recording, and then there's also access to future sessions. So we'll be doing a bunch more of these. So thank you very much, everyone. So we can move off housekeeping. Little bit of background about BDO and our focus on private equity first. So we specialize in helping companies prepare for private equity, navigate that private equity process. And we also work with private equity firms and their investments as well. And it's a real focus of ours. So last year we were ranked #1 globally as advisor for private equity with 829 transactions, I think, if my details are correct. So that was ranked by PitchBook. So it's definitely a focus for BDO globally. It's one of the 6 key sector groups that we focus on. So, one of the things we want to do today is really start getting that message out in Australia as well. So one of the things we do that's slightly different to our peers is that we want a holistic relationship with private equity firms and with the investment companies. So we want to not just help them through the transaction phase, we want to be there through the entire life cycle and their journey. And so that's the entire PE investment life cycle and actually beyond that. So in an effort to try and give some color to that, we've actually broken that life cycle down into 4 key parts. And you can actually, I won't go into too much detail today, but it is actually on our website. So there's 4 key areas. There's demystify, navigate, accelerate, and realize. And really broad terms, demystify is trying to get clients and our clients to understand what private equity is, will it work for them, etc. And then navigate is really trying to actually help those clients get access to private equity. Accelerate is once they've actually had that investment by private equity, how do we work with them to grow the company? And then realize is assisting them through the exit process. So I won't go into too much detail about that, but today we're talking about the first in that list, which is demystify. And it's really appropriate because we speak to a lot of clients about private equity and I just don't think it's well understood. So hence the reason why we've got Mark here to help explain how private equity works. So today it's really broad. So today we're talking about demystify private equity. It's virtually a helicopter view of what private equity is, and this may or may not be appropriate for everyone in the audience, but we will be following up with more deep dive seminars post this, where we actually focus on really key elements of private equity and the transaction process. But today, demystify was really to give that broad overview, and hopefully so that everyone gets an understanding of whether private equity is appropriate for them and their business and whether they want to understand more. Now, Mark, so to kick things off, I think what we should do is just get a little bit of knowledge of our audience. So we've got, hopefully if this technology works, we've got a poll that will just give us an understanding of what our audience is like. So it's really around how will you rate your understanding of private equity. So low, medium, high, and superstar for our M&A people on the call. So if you don't mind, please take a couple of minutes to input there, and then we can move on from there. While we're waiting for that, Mark, I'm going to throw you on the spot here, but why do you think private equity is so misunderstood? Do you have a feel for where you think?
I was thinking that when you were talking, giving that intro, Seb, I'm not surprised when you say a lot of your clients don't understand it. You know, I work in the industry, and I still, you know, understand how to coming to understand how to navigate it. I feel like, you know, the reason it is hard to put in a box is because there are so many boxes or parts of those boxes. You know, if you look at the chart that flashed up momentarily before, you've got private equity. You know, I think of private equity as capital and management support for a business, but that capital and that management support can take many different forms. You know, it depends on the stage of the business. You've got early stage businesses and later stage businesses. It depends on the industry, you know, whether it's consumer focused or not consumer focused, B2B focused, software, not software, and size of check, you know, the amount of investment that's being raised. And maybe we talk about that in a second and where Armitage fits into that landscape.
Yeah, no problem. Thank you for that. All right, we've got a little bit of understanding of our audience, so it's kind of good in a way, given that it was a high level presentation. A lot of people fitting into low and medium, maybe they're being polite, but that's really useful for us, so we know what our audience is looking for. All right, let's move on. So we did flash a chart up before, and maybe we can flash that one up again if we can. Amy, if you don't mind, that's it. So just to give you a little bit of color, and Mark referred to it before, there are so many stages of private capital. And so it ranging right from angel investment, venture capital to private equity. And today, just for everyone's benefit, we are going to focus on that private equity or the later stage businesses that are cash flow positive and really looking for some growth capital from here. So just there are lots of other versions of private capital, and today though we're only focusing on the PE side of things. All right, so we can move off that one just so that I've clarified where we are focusing. And the next chart that I thought was really interesting is we've looked at the quarterly indexed returns for a lot of asset classes over the last 5 years. And if you have a look, and I won't labor the point, but if you have a look at the last period since March 2020, there's been a huge tick up in 3 of the key categories. And they are effectively venture capital, private equity, and the public capital markets. And they've really taken off since COVID hit, which is really interesting. And the leading one out of all of those is private equity. So it is a very sought after and focused area. And I think that's important for us to understand that it is moving in the right direction here. So we can move off that one. Thank you. So Mark, really over to you. What I was hoping to get right at the start is let's take a high level view. You know, what is private equity? You know, is this something that our clients should be considering?
Yeah, and I think, you know, back to the, you know, your first question, and again, that chart that you just showed before, I'm not surprised to see those kind of return metrics. There's just a ton of capital flowing into alternative markets generally, and private equity as a participant of that has been a beneficiary. And I think the underlying companies that private equity invest in as a result, you've seen valuations go up and returns move as a result of that. Like I was saying before, there are 100 flavors of private equity and alternative capital more broadly. The way I think about it is capital and management support into later stage businesses that are profitable, that are growing, where the business needs capital and management support. Now, what we Armitage focus on a very, very narrow subset within that broader remit. You know, our focus, as you know, Seb, we write $10 to $20 million equity checks into businesses generating between $2 million and $10 million of profit, where a business owner doesn't want to sell out. They may want to take some money off the table and or put money into their business for growth. But beyond the capital, what they want is a very, very active partner alongside them in the business to help them map out and execute on a growth plan. And we do that within a number of target end markets. But for us, our focus, about 50% is in enterprise software or pure play software business models. The other 50% are in real economy business models. But those real economy business models are really non-discretionary, recurring revenue type end markets. And so, you know, on the software side, we've invested in everything from the biggest ERP software provider into primary schools and high schools in Australia, and one of the biggest software providers into the NDIS and community care end market, all the way through to the real economy side. We've invested in and partnered with a big waste recycling products and services business, and one of the biggest specialist animal referral hospital operators in Australia. So it's a pretty broad remit, but I say all that because our focus is on a very, very narrow niche. You know, we're focused on founder-led businesses, a business owner who doesn't want to sell out. They want capital for growth. They want a partner for growth, and they are operating in an industry that kind of ticks the boxes that we were talking about before. I think for the people that are on this call who've got businesses who are talking to BDO about, you know, whether private equity is right for them, I think, you know, the thing that they need to be asking first and foremost is, what are they solving for? Because they need to tick the box of, I want capital, and they need to tick the box of, I want help. But what that capital takes and what form the help takes will be very, very different for different business owners and for different businesses. Like I said, Armitage and the part of the market we focus on is a very, very small niche. And I say to most founders when I, you know, have a conversation with them about our model, you know, we're not the right fit for most founders. You know, a lot of founders don't want a partner, they don't want the help, or they don't need capital, or they want to sell 100% of their business, which for some private equity funds is great, but for people like us, it's not, because we want to be invested next to the founder. There are a list of things that you really need to work through, I think, to understand whether or not A, you need the capital, and B, you want the help, and then work out, okay, well, given that, who's the right kind of specialist fit for me? Does that make sense?
Yeah, definitely. I mean, that's our whole focus with our clients, really is working out, well, what do you need the capital for? What are you going to spend it on? And then we work out what's the best source of that capital, because yeah, quite often I think people are not necessarily understanding what their needs are. And so we spend a fair bit of time modeling, you know, what are their capital requirements before you actually go down this path, because yeah, to be fair to you, like it's dilutionary if you actually take too much capital and you don't need it.
Yeah, and I think, you know, everybody, when they think private equity, they immediately jump straight to the capital point. I think that the management support and, you know, what does the founder want as a partner is equally, probably in my mind, more important. You know, I say to people, capital is the commodity. You know, what are you solving for beyond the capital? And I think that's really important. Every founder is solving for something different. Some are solving for help corporatizing their business, you know, bringing in an institutional investor with experience, helping to turn it from a family-owned business to more of a corporate. Some are solving for the fact that they no longer want to run the business anymore. They're looking to retire, they're looking for a succession planning solution, or they're looking for a full exit of the business. And certain private equity funds can help solve that. Some are solving for expertise around particular functional or industrial parts of their business. You know, they want help executing on M&A. They want help moving into a new geographic area, this, that, or the other. And I think being really specific on those requirements beyond just the capital requirements are important to make sure you bring on the right partner, because, you know, I think of these things as a marriage. You're a long time married. Yeah. You want to make sure you're getting into bed with somebody who's a good fit for you. And that's, you know, obviously the cultural fit with the founder is ranks very, very highly on that list, and we can probably talk about that more in the conversation.
No, I think that's a really good point. I think anecdotally, I think most of the time we speak to people who are looking at PE as an investment, it's really where you've got this fantastic founder-led business that's tied up their entire retirement savings in a company. They can see the next growth area and the strategic story, but they're worried about taking that level of risk. And so partnering with somebody who could bring something to the table more than just capital is important. So yeah, there's lots of reasons why people approach us looking for PE, but that one just comes up time and time again. Yeah, they might be looking at geographic expansion or vertical integration or whatever it is. Do they take the punt with their own capital, or do they try and share the risk?
Yeah, I get it. And again, that's a conversation we have again and again. I think it's a really good reason to be having a conversation with a partner, just, being able to de-risk. As I always say, most of the founders we speak to are 20-year overnight successes. They've built these great businesses over a long period of time. Like you said, Seb, they've tied up most of their personal net worth in these businesses, blood, sweat and tears, 24/7, for 20 years in the business. There becomes a logical point where they want to be able to de-risk and be shown some recognition for that, that investment, which is completely appropriate. But B, as you say, the business evolves, and I think of businesses in stages, whether it's in FTE numbers or profit numbers. A $2 million profit business is very different to 5, which is very different to a $10 million profit business. A 10 FTE business is very different to a 30 to 50 FTE business. Again, it's very different to 100 to 200 FTE business. Those are transitions that a business makes, and I feel like, back to the capital versus management support, the capital is almost the easy part. The important part, and I think, the role that firms like us play is really helping the business through those transitions, getting them from a smaller business to a bigger, medium-sized business to a bigger business, and making sure the infrastructure is in the business to support that scaling up, to execute on the M&A, execute on the geographic expansion, all of those good things, but also making sure that the business, is able to scale through those different stages. That's particularly for Armitage, a really important role that we see ourselves as playing.
No, that's really interesting, and we'll get to a little bit more of the detail after you invest a bit later on. But so you mentioned before that PE might not be the right solution for every situation. So where do you think PE isn't the right solution?
I think it isn't the right solution when you've got a fiercely independent founder who doesn't want another stakeholder around the table, and they don't want a partner. I think, if you're a founder and you need capital, there are different ways to solve that capital need, right? Particularly in the market that we're operating at the moment, where there's, a vast availability of debt and other financing solutions. There are alternatives there. I think the capital is not, it's a necessary but not sufficient reason to go down the private equity path. I think the second gate is more important, and that's the part around wanting a partner. And we, to be honest, we speak to businesses that are highly cash generative with strong unleveraged balance sheets that, capital for them is really just, it's not even on the radar. The reason that they want to be talking to us is because of the second point only, which is we want a partner. We're at a point in time where we just need help getting from the business to the next level. We don't necessarily want somebody to come in and run the business, because we as the founders love running the business. We want to keep running the business, but we want somebody else losing sleep at 10 o'clock at night because something's happening in the business. It's very lonely at the top. We want a partner in the trenches with us, thinking about, the day to day. And I think that's where a partner like this makes sense. It doesn't make sense for somebody, who not wrongly, potentially, completely appropriately wants complete autonomy and independence within their business.
Yeah, no, I completely understand that. I think one of the other areas that I think might be interesting for our audience is just sort of what are the key sectors that are interesting to PE. And I know there's a standard profile, but there's also, I suppose, themes that are happening based on what's happening with the macroeconomic part of the market. So I wonder whether you've got any comments on that.
Yeah, look, I think that's changed a lot, and I mean, you'd have a view on this as well. I think like when I was 10 years ago, when I left the US, the common answer to that question was, boring, recurring revenue, contracted high cash flow generative businesses that had leverageable balance sheets. I think we've come a long way. That industry's come a long way since then. Where you've back to the 100 flavors of private equity, you've got firms that are really well geared to invest in particular industries, and so you've got some phenomenal firms that really focus just on consumer and branded FMCG, stuff like that. It probably wasn't the mainstay of private equity a decade ago, but whether it's here or overseas, you've got you've got firms that are dedicated to that. You've definitely seen, the rise over the last decade of, SaaS, software-focused investment houses that will just do software. You still got the, traditional asset-heavy, non-discretionary real economy business models that are, you've got private equity funds investing in them. To be honest with you, they probably got a lot less attention over the last decade, even though that was probably more of the traditional model. And so I think, you've got an investor type for every industry type. I think where you've seen the most growth over the last 10 years, definitely over the last 5 years, has been in those software business models, particularly from a growth equity standpoint. And that's because of the scalability and the unit economics of those types of business models. But one thing that Australia definitely is not lacking, I don't think, is an availability of capital. And so I think if you're a business that has a need for capital and wants a partner, I don't think that you'll have any trouble finding a partner. It's a matter of finding the right partner, somebody that's got the particular experience in the industry and the functional area that you're solving for.
Yep. No, I think that's a very good answer. It is a hugely sophisticated market now, I think. So if we move off whether PE is right for you and sort of focus a little bit more on being investor ready. So I think what we mean by this is that I don't think you really can just walk up and suggest that you need private equity investment. I think you've really got to do a little bit of homework, and we've obviously got a view on this, but I'm curious to see from a private equity perspective. I know you always want sort of a first run at an opportunity, and processes aren't a big focus for private equity firms, but at the same time, you do probably need them to be equipped and ready for this investment. Have you got any views on what makes a company sort of ready for investment from private equity?
Yeah, it's a really good question. And, I smile when you say, don't like processes, but at the same time, absolutely do like it when there's an advisor there, because they've done a lot of the pre-work on getting a business through some of these points that we're about to talk to. I think, there's a list of things that we look at when we're looking at a business. And I'll talk to that, I guess, some of the stuff that we really focus on in due diligence in a second. But if I had to say the two things that you really, as a founder, you want to make sure you've ticked the box on before you start that conversation, and they both sound pretty rudimentary, but you'd be surprised how many founders aren't necessarily across it. First is, where do you make money? And the second is, as a founder, what do you want to do? So the first one, where do you make money? We talk about the unit economics of the business and really understanding, okay, well, who is your customer? What are you selling to them? What are the unit economics from that customer? What's the revenue? What's the cost to service, cost to deliver, and how scalable are those unit economics? That's the first really important thing that we focus on, at least when we're looking at a business and speaking to a business owner. A lot of business owners know that intuitively. They wouldn't have been able to grow a successful business, without being able to, do that well. But often it's intuitive, and they need help from somebody, like a BDO, actually documenting that and getting it down on paper to say, okay, well, this is the financial profile of the business. This is the unit economics of the business. And if there's a founder on the call that wants more detail on that, I'd strongly suggest you speak to Seb or somebody from his team about it. I think the second question, again, sounds equally rudimentary, but really important, is, what does the founder want to do? Like, what are they actually solving for? Back to the point before, You know, are they solving for de-risking personally? Are they solving for a partner in the trenches, you know, to be able to call at 7 o'clock on the drive home on a Thursday night because something's gone wrong and they just want somebody to bounce stuff off? Are they solving for particular functional expertise around M&A and expansion? Are they solving for particular industrial expertise because they're doing a step out into an adjacent industry and they want an investor or a partner who's been in that industry before? There's a list of things that you could be solving for. And again, I feel like a lot of the time, or, you know, another great example, I'm solving for succession planning solution. I've built a great business. My kids aren't interested in being in the company. I'm 60 years old. I don't want to be doing this forever. I still want to be a shareholder, but I don't necessarily want to be running the business. How do I think about succession planning? I think they're the kind of things that are important for a founder to work through and would typically be speaking to somebody like yourself on. And based on the answers to those two questions, I think it makes it a lot easier to then find the right kind of partner to partner with, back to the conversation we were having before.
Yeah, no, I completely agree with that. I think we see a lot of clients, and that's the first thing we focus on, is that what do you want to do? And sometimes we're working through, you know, they might be looking at a trade sale, etc. But by the time we work through, you know, what is the story of the business? What's the strategic growth story? Because that's important as well. Quite often we actually come full circle and they actually don't want to fully sell out. They just thought that was the only option on the table. And to partner with somebody and to continue that growth and to stay in the business a bit longer is actually quite interesting to them. So we tend to find that if you actually work through with them, what does the growth story look like? They actually get quite excited and actually want to stay in and partner with somebody to do it. So it's you never know until you spend that, the owners.
Couldn't agree more. And it's funny, I say that to our, you know, Alan and Carol Swartz on my board, and Graham Goldsmith, who's our chairman, a lot. You know, it's important for founders to often demarcate being a shareholder and being the executive in their business. And a lot of people feel like, you know, to your point before around going full circle, a lot of people feel like, well, if I want to do a transaction, my only option is to do a full sell down to a trade buyer, and that's a solution to solve a particular issue like, you know, succession planning, whereas, you know, they speak to somebody like yourself, there are actually a bunch of other options there. And in particular, demarcating between being a shareholder and a founder executive, I think is a really important distinction that, you know, is not often obvious, you know, to a founder.
Yeah, definitely. And look, and private equity is not always the answer. You know, quite often we'll go through that process and it could be anything else. It could be a listing, it could be anything. But I think private equity does represent a huge opportunity for people that's not well understood. So just going through that investor ready thing again. So how important is the management team to an incoming investor?
Yeah, I think it's obviously really important, depending on the business and the type of investor you're taking on. For some, it will be more important than others. So for somebody like us, what's really important is the founder and the relationship with the founder. And then a big job of ours, typically when we work with founders, is they'll have a couple of great employees, managers on their team. But one of the reasons they'll be partnering with us is looking for assistance, bolstering the executive ranks and bringing people in to play particular functional roles that haven't been necessarily filled already. There'll be other private equity funds that are probably less focused on that, who'll want to see a more fully baked exco in place. And there'll be yet others that are more focused on full buyout, where they'll look to bring in their own executive team into the business after they invest and acquire. So I think exco and executive team is important, but again, I think the executive team dynamic that you've got in the business will influence who the right kind of partner is for you, rather than the other way around, if that makes sense, because I think that will dictate who the right kind of partner is for your business. Yep.
I think one of the things that we do spend a lot of time on at BDO is really getting a business ready. So we're looking at their financial reporting, looking at their governance models, etc. And then obviously looking, you know, quite heavily we do at the forecast. So for us, financial modeling of where the business is going, what capital they need to realize their ambitions is important. You mentioned earlier about your view on what's important under due diligence. Obviously we're embarking on those processes because we think they add value to the investment process. But I'm keen to understand from your point of view, what are the key issues that you look for when you're doing due diligence on an acquisition or an investment?
Yeah, great question. And I think, back to my point around unit economics, where does the business make money, and the forecasts that flow off that, that's really important. Typically when we're working with a business that hasn't, engaged somebody like yourself, that is the starting point, just getting the financials of the business down on a page historically, and then forecast that going forward, just so that we understand the levers, like what we would call the levers in the business that drive those unit economics. I think extending off that, so that's point one. I think that's a really important role that, a BDO plays in that example, getting the business ready. I think the other thing, when I think about the 6 months leading into a transaction or a partnership for businesses that we partner with, there's that, but then there's the growth plan. And the growth plan for us is, what does this business look like in 3 to 5 years' time? Because that's really all you can plan for. And what is everything that the business needs to be able to execute on that plan? Capital, resources, systems, processes, M&A, big, commercial partnerships, whatever it may be. And then being really, really specific around, okay, this is everything that needs to happen between now and over that 3 to 5 year period to be able to get the business to where we collectively want it to be. And the reason that's important for us is, A, it sets the plan. And so it's, very granular and clear what we're building, who's on the hook for what, and what we need in the business to execute on that. But probably what's more important for us, and again, this is the one takeaway I'd hope that founders take from this conversation, it's really important that there's alignment on that with the partner before you pull the trigger. Because, as I said, I think before, I can't remember if we were actually, on the interview when I said this, but I feel like, it's a marriage, right? You want to make sure you've got complete alignment with, the investor and the founder before you pull the trigger on that marriage, because, otherwise that's where problems arise, and disagreements. It's often just as simple as, well, I thought we were doing this, you thought we were doing that. I think the more granular, transparent alignment you've got between a founder and an investor, the less troubles you're going to have down the path. And so, at least for Armitage, that's really the focus for us when we're partnering with a business and investing in their business. It's making sure we're really detailed about what we're building, what are the desires of the founders, and then making sure that the plan reflects that.
Yeah, no, I think that's massively important. I think that alignment, both culturally and strategically, is critical, and that's sort of where we focus our clients. One of the things that comes up, and it's a bit of a left field one, when I'm talking to our US counterparts, they're always saying, BDO, we help them through the process, we get them investor ready, and then we're supposed to help them with the pitch. They're big on pitches in the US. What's your take on whether the pitch is really important, or whether it's getting to know the founder and that alignment you talked about?
Yeah, I think, that is a great question. And I'm a sample size of one, or Armitage is a sample size of one. So take this with a grain of salt. For us, it's not important, right? It's not at all. Like, people send us IMs. They're great to read. There's a famous Charlie Munger quote about a transaction that he and Warren Buffett did where, they were investing in a business. An investment bank had done all this work on it. He said, the investment bank said, hey, the company paid us $1 million to do this work. Can I send you the pitch? And Charlie Munger's retort was, hey, I'll pay you $1 million not to send me the pitch, because I'm not going to read it. Something along those lines. And I feel like, it's one thing to be what's written in a PowerPoint pack, in an IM. In the end, it all comes down to relationships and, the conversation between a founder and a business. I feel like the Charlie Munger quote is a little bit extreme, because I feel like it is really important, back to what I was saying before, getting documented. This is how the business makes money. This is the unit economics. And this is what the founder is solving for. I think those two things are really important. And that's what the IM or the pitch or whatever it is should be documenting. Beyond that, I feel like it comes down to the relationship between a founder and the investor, and then their collective definition of, well, this is what we're trying to build with the business. Yeah.
No, I agree with that. I think it's very much an American thing. I mean, you need a certain level of detail to get an investor interested, but at the end of the day, you really can't manufacture a result. At the end of the day, it's got to be in alignment strategically and culturally. So, yeah, no, exactly. I'm glad you answered that way. I was just moving forward because I'm conscious of time. I think maybe I'm keen to get to the point around the journey after investment, but I know we've got a couple of other things to talk through. Assessing readiness, all right? So what we talked about is, as you said, sort of getting your documentation, etc., ready. Do you have a view, and this is where I think it will lead into your investment, of how much time is required before investment to be ready? Do you have a view as to whether or not they need a certain amount of time to get ready for investment?
Yeah, I think every business is different, and to be honest with you, you'd have a more intelligent opinion on this than me. In my experience, I think it's 3 to 6 months. Yeah. Like I feel like that's the amount of time it typically takes from a standing start to get set on a bunch of those things, at least for the businesses that we work with, where we're coming to them, building, about 2/3 of the businesses that we speak to in any given year as a result of direct outreach to the founder, because they're in a target end market, target profile of business that we want to partner with. The other third comes from the network or somebody like yourself at BDO. I think in those first 2/3 where they're coming from a standing start, where we, approach them unannounced, it typically takes us 3 to 6 months to work with them to get the house in order around unit economics. What does the founder want to do? Define the growth plan to then be in a position to invest. And so I'm not sure if that's consistent with your experience.
Yeah, look, it was a bit of a loaded question. Look, my view is that you do need a certain amount of time to really understand where the business is going and where the founders want to go. And I don't think we find most people turn up and say, hey, we want to do something immediately, but by the time you work through it, you're definitely talking 3 to 6 months. And then there's the whole transaction phase. But I think, the interesting part is that we spend so much time talking about getting a business ready for investment. The whole investment process is pretty in-depth with due diligence and sale and purchase agreements and all that sort of stuff. But I think the key thing that probably isn't focused on enough in these discussions is, okay, we've done that. We've now invested in the business. What happens? What's the relationship like from day one of the joint investment, and what should a founder be expecting that looks like for the period after that? So if you don't mind giving us some color on that. Sure.
And like I said, I can only talk with the sample size of one being Armitage in our perspective, but first 3 to 6 months, it's all about setting the growth plan. That is our focus for due diligence. That is really important to get alignment. 6 months after the check clears and we're in business together, it's about executing on that sprint plan. And so we call it a sprint plan. We basically have, a very detailed list of key initiatives or value drivers and enablers with the business. We have action items and timelines and owners from Armitage, from the company associated with those items. And the first 6 months, Andrew Coventry, who's our portfolio director, has a great expression for this about getting the boulder rolling. It's really about getting momentum on the boulder, getting it turning, picking up momentum, just ticking things off a list. And it's really surprising how effective, how cathartic and effective that is in just, creating momentum in the business as you bring in a partner. And then beyond that, over the next 6 to 18 months, beyond that initial period, it's really focusing on the important things. And, you can see a lot of change in a business over a 6 to 12 month period. That's done in a very planned and methodic and constructive way that can still preserve the entrepreneurial and founder-led culture of the business, which is really important for us. Like, we invest in businesses because of the culture, because of the founder. The last thing you want to do is make wholesale change to that and you know, disrupt a formula that's already working. But at the same time, you are making change. You're putting resources into the business. You're putting new systems into the business. You're expanding the business. How do you do that in a way that preserves the culture and the fabric of the business, takes the best of that and lifts it up a level? And so, you know, how does that manifest itself? It manifests itself in new hires in the business. It manifests itself in new operating locations within the business. It often manifests itself in changes to systems in the business that make the company more scalable. So new ERP system, new rostering system, new whatever, you know, whatever it might be. So they're the kind of things that I think a founder should expect to be working through. And then, you know, depending on the founder, you know, they might be solving for other things over and above that. You know, we've got examples of founders who are specifically looking to do a transaction. Great example of business that we invested in at the end of last year. You know, the founder, husband and wife team, great entrepreneurs. Founder made us really clear, hey, within 6 months' time, I want to be the executive chairman. I don't want to be spending 5 days a week, let alone 7 days a week in the business. I want to be doing 3 days a week in the business. We need to have a COO in place who's got a clear path into the CEO role. And I'm looking to you guys as Armitage to help me do that. And so in that case, we ran the hiring process, you know, found people from the network and beyond, hired that person. We had an operating partner from Armitage stapled in that business alongside their exco, helping them to execute on day-to-day initiatives within the team. They're the kind of things that I think a founder should expect from a very hands-on partner in their business.
Yeah, definitely. And inevitably, there's going to be challenges that you come across. I think, what is the best way that you work with founders to overcome challenges along the way, or disagreements in strategy, etc.?
Yeah, I think, look, I say to founders all the time, if you're ever looking to legal documents for an answer to that question, you're in big trouble. You know, you've already lost. You know, it's all about the relationship, and that's why, you know, back to your very first question, you know, who should be thinking about private equity, or how you think about it's all about the partnership. It's all about the relationship between that founder and the investor. And if it is not, you know, a really high quality, trusting, mutual respect relationship, then it's not a trigger that should be pulled, because, as you say, there will be disagreements. There will be different points of view. That's ideally the reason somebody is doing a transaction in the first place. From our perspective, you know, we are in the business of backing founders. And so, you know, ultimately we're going to defer to them on how they run the business or want to run the business. But that's not to say that we don't come in with a strong opinion on a whole lot of things. And so it's about having that respect, being able to work through and have a conversation about, well, what is the right thing to do here? And again, that's why getting alignment on the way in before you pull the trigger is so important.
Yep. And once you've sort of gone through that growth process, etc., what is the exit strategy for both you and the founder then?
Yeah, again, we're a sample of one in Armitage. We've probably got a unique view on this. You know, what I say to our investors is the only thing that happens when you sell a good business is you pay tax, and you've got to find another good business to invest in, and you've got to find another good partner to partner with. Ideally for us, we're investing in great businesses, great founder, where we can take a long-term view and grow it over time. That doesn't mean that you won't sell a business at some point. And for us, you know, I talk to founders and our team about the difference between being, you know, exit planning and being exit ready. And there's a difference. You want to have made the investments in the business that we were talking about before, so that at the right time, if and when it makes sense to pull the trigger on an exit, you're ready to go. But unlike a lot of private equity funds, we're not planning that exit from the day that we invest. As you well know, Seb, you know, the traditional private equity model is 3 to 4 years after you invest in the business, you're looking to sell that business because of the fund cycle. You know, we're a little bit different in that sense.
Yeah, no, that's a fair point. I think the other thing that is sometimes a difficulty when we're talking to clients right at the start is that, you know, private equity probably does give you almost 2 bites of the cherry, though, in terms of there's an initial level of capital that might come to you. Obviously, a lot of it's got to go back into the business to grow the business as well, but there's an ability to take some money off the table, but then retain a level of interest, and then almost sell out again if there's an opportunistic play. Do you want to talk a little bit about that?
Yeah, look, I think that's you described it really well, and like that's a big conversation point that we have with most founders. There'll be few investments that will be as good as a business that you understand as well as you do as a founder, and that you have as much control over as you have. And so if you're in the luxurious position of being able to do a partial sell down today, take money off the table and de-risk, retain a material stake in that business going forward and continue to grow it, ideally, that second bite of the cherry, to use your expression, is materially bigger than the first one, because you've grown a much bigger pie. You've created a much more valuable business. Whether you sell that business or not in 3, 5, 7 years time is another thing. Absolutely could be sold. And, there's examples of businesses that we've invested in where, we've sold the business within 18 months of that initial partnership because it was the right thing to do for the business and the founder. And they generated a lot more economics on the second bite of the cherry than on the first, because there was so much value that was created in the business. I think, what I'd say to founders is, again, if you're thinking about it with a founder hat on, there's the first transaction where you de-risk and you bring in a partner to help you grow the business. Then you grow the business. Ideally, what you're looking for at that point then is option value. You could sell the business and realize that again, and hopefully everybody's done their job. That pie is a lot bigger. It's worth a lot more, and you've got a very valuable realization event there. Or you can continue to grow that business again, and you've got option value on another 3 to 5 years continuing to grow the business. So I think that's the great thing about private equity in my mind. Definitely biased with respect to Armitage's view, but private equity more generally, it should just create a lot of option value for a founder. Once they've de-risked, taking the personal stress out, if they've got all of their wealth tied up in that one asset, they've got a partner then to help them execute on the next stage of the growth plan. You execute on that, and then you've got option value, to do what you want with that business. That's ideally a very valuable business, particularly if it's continuing to grow and it's in a growth market.
Yeah. Thank you for that. Now, I'm conscious that we are getting sort of close to the time, so I'm just wondering whether there are any questions that have come through the audience. You and I have had a good chat for a good 50 minutes, but I'm just curious as to whether there's any questions from the audience. Amy, was there anything that we needed to go through, or do we keep moving on? No, keep moving? Brilliant. All right, we'll do that. So we're sort of coming to pretty much the close then, Mark. One of the things that I suppose is just, there's been a lot to digest, and we've tried to cover a fair bit of ground on demystifying private equity. But if there's any sort of last insights that you might have, or final thoughts that you think might be worth sort of positioning with our audience?
No, yeah. Look, I think that the message or the through line for me is capital is not the rate limiting factor, right? Whether it's a commodity or not is another thing, but there is a lot of it out there. I think it's the partner that's a really important point. Finding somebody that's got experience in the industrial or functional part of the equation that you're trying to solve as a founder, that's the most important thing. And so, spending time thinking about that, what am I solving for, and who can solve this because they've got particular experience, or they've got a business model that's geared up to help solve that problem, whether it's expansion related or succession planning related, or this, that, or the other. I think that's where I'd spend the time.
Yep.
And, I think it's a really, really exciting time to be an entrepreneur, because there is a lot of capital and specialist providers of capital out there to support, different founders. So, what a great time to have a business.
Yeah, brilliant. And just before we go, there was a question that just popped up on my dash here. How is the COVID pandemic factored into valuations? So I think that's going to be an interesting one. You might want to have a first crack, and I can have a crack at it. So how is How is COVID and the impact on businesses trading impacting valuations?
Yeah, I think two things there. I think if you're a business that can show you've been very resilient through that COVID period without disruptions, I think that's just a positive, right? So I think that's one observation. I think the second observation, which is more where the question was coming from, is, you know, we in all businesses that we're investing in now and partnering with now have to make an assessment of, you know, the COVID bump in both directions, because some have had a bump one, you know, positive direction, others have had it the other direction. I think that's, you definitely seen investors like us take that into account, and just wanting to be able to look through what I call through the cycle in terms of a COVID adjusted earnings base when you're thinking about valuing a business.
Yeah, no, look, and we come across this all the time from on buy and sell side. I think you're right. You've really got to hone in on how much that is impacting the business and what is the go forward position from here, because we are theoretically coming out of this pandemic at some point. So you're looking at longer term value, and so we do a fair bit of work there, because I think the initial view, depending if you're a buyer or seller, is it's going to have an impact on value. But I think once you actually distill it down, you know, most of the businesses, if it's not hospitality, etc., it's probably not having as big an impact as one might initially think.
Yeah, or you can normalize for it and get comfortable with an underlying bit earnings that's not going to go away. Exactly.
Yeah, that's so cool. I think sort of last comment from me is that, I mean, when we speak to so many businesses, we work on buy and sell side for private equity as well as raising capital for our clients. I think the key element is sort of doing a lot of work around where is the business going. Like we do, it sounds a little bit too accounting speak, but really, what is your growth strategy? What are the financial model that supports that, and a realistic financial model that is keenly focused on what are the drivers of the business, what is the capital you need to deploy to make sure that you can accelerate the business, and then we actually allocate, you know, what is the right capital source for you. You know, I think people sometimes jump straight to the answer rather than actually go through that workshop exercise, and it can make a huge difference, because as you said, you know, it is a partnership. It is not just capital that you're after at the end of the day, and so really you've got to do your homework up front, and that does take a bit of time. As simple as that. So I think that we are at the end of the presentation. So thank you, Mark, for your insights. Always brilliant listening to you. You've got such experience in this sector. That's why we asked you to come on board. I think from my perspective, this is the start of BDO's real focus on, maybe educating is not the right word, but actually positioning how we can assist businesses in this area. So we will see a bunch more seminars coming out from us, deep diving into certain areas of private equity. So thank you very much for your participation, and we will be in touch shortly.
Thanks, Seb.
Thank you.